Mitch Goldberg, ClientFirst strategy. When I think about investing in emerging markets, I think about investing in foreign economies that are rich in natural resources, that have cheap and abundant labor, and that offer potential upside for investors. But it's the risk premium where I would want to invest in emerging markets, meaning I would expect the potential return from emerging markets to be a lot higher than what I would potentially earn from investing in U.S. stocks. Now, I would need that risk premium to convince me to take the associated risks of emerging markets, and for the better part of the last 10 years, investors have earned a pretty decent risk premium by investing in emerging markets, and certainly far and above what they would have earned from investing in the U.S. stock market. But should we expect this to continue? Let's take a look at the B.R.I.C countries as our proxy for emerging markets. B.R.I.C, B-R-I-C, is a commonly used acronym for Brazil, Russia, India, and China. To help make this decision, let's take the B.R.I.C economies one by one. Brazil was once lauded for its energy independence and is now importing ethanol. Russia, in my opinion, too corrupt and too dependent on energy resources. India, very messy political system, regulation limits foreign investment too much, and too little financial flexibility due to that country's high level of sovereign debt. China's super inexpensive labor isn't so cheap anymore due to a rise in wages. Their economy is either soft landing or hard landing, but either way, it's a slowdown. And the country has a lack of domestic oil and gas resources, which makes manufacturing there more expensive. And don't forget, Europe is China's biggest export market, and we all know how tough things are over there. Now, I don't want to come off as a xenophobic investment professional, nor am I offering blanket advice to avoid investing in emerging markets. I am simply laying out my case for a new emerging market. So the next time you hear B.R.I.C, B-R-I-C, I want you to think U.S.A. The U.S.A. has tremendous stable natural gas and oil reserves, abundant population available to work, an English-speaking population, and wages, while clearly not as cheap as they are in China, the competitive difference between the two countries is definitely shrinking. The key, the bottom line, is that when executives of major U.S. manufacturers see this, I expect them to find that it makes sense to manufacture domestically. And if you throw in the Iranian threats to close the Strait of Hormuz, an action that would actually hurt emerging economies more than ours, I think it'll make our stable energy reserves a critical factor in deciding whether or not to manufacture domestically or abroad. Now, I'll conclude. A manufacturing and economic renaissance, in my opinion, is starting to take hold and is very underappreciated. Add to that the widening of the Panama Canal, which should be completed in 2014, then I think that even the most optimistic expectations for both stocks and the U.S. economy may not be optimistic enough. Now, in recent videos, I predicted we could see Dow 14,000 by the end of this year, today, January 17th, 2012, or by January of 2013. That would equate to a roughly 13% move higher from where we are now. A lot to ask for, but certainly well within the realm of possibilities. Now, about a third of the Dow stocks haven't moved up in the last 3 years, but are all in some form or fashion of a restructuring or a turnaround, which could propel their stocks higher. So you add it all up, and I think the risk premium favors U.S. stocks. Thanks for watching. I'll see you next time.